The journey through understanding credit scores continues, moving from what they are, not to what they truly represent. We've established that these models are intricate risk prediction systems. Now, let's delve into the very heart of how these systems are structured. Most major credit scoring models, the ones that impact your financial life significantly, are built upon the evaluation of 5 primary categories. These categories are the pillars upon which your creditworthiness is assessed. Imagine a 5-section pie chart, each slice representing a crucial aspect of your financial behavior. The first and often most impactful slice is payment history. This looks at your track record of paying bills on time or not. Next, we have credit utilization, which measures how much of your available credit you're actually using. It's a ratio that speaks volumes about your reliance on borrowed money. Then comes length of credit history, a testament to your experience and consistency over time. The longer you've managed credit responsibly, the better. Following that is credit mix, which assesses the variety of credit accounts you hold. Do you have a healthy blend of different types of loans and credit lines? Finally, there's new credit activity, which examines recent applications for credit. Too many new accounts in a short period can sometimes signal increased risk. Each of these 5 categories doesn't just exist in isolation. They are assigned a specific weight within the overall scoring algorithm. This weighting determines how much influence each factor has on your final score. It's not a one-size-fits-all scenario. Some categories carry significantly more importance than others. Understanding these weights is key to strategically improving your credit. For instance, a category with a higher weight will have a more pronounced effect on your score, both positively and negatively, depending on your actions. Conversely, a category with a lower weight, while still important, will have a less dramatic impact on your overall credit standing. This intricate balance ensures a comprehensive, albeit complex, evaluation of your financial habits. It's designed to provide lenders with a reliable snapshot of your repayment probability. Now, let's begin to break down each of these critical categories individually. We'll start with the one that typically holds the most sway. Payment history typically carries the largest weight in most credit scoring models. It's often considered the most crucial indicator of future payment behavior. Lenders want to see a consistent pattern of on-time payments. This category meticulously examines your record of fulfilling financial obligations. It scrutinizes every payment you've made or missed across all your credit accounts. Specifically, it looks at whether your payments were made on time. It also notes any late payments, which can significantly impact your score. The severity of delinquency is also a factor. A 30-day late payment is less damaging than a 60-day or 90-day late payment. Furthermore, the recency of missed payments plays a vital role. A late payment from last month carries far more impact than one from 5 years ago. This is because recent behavior is generally a stronger predictor of immediate future behavior. Recency matters immensely in the eyes of credit scoring algorithms. A single recent late payment can cause a noticeable drop in your score, even if your overall payment history is otherwise stellar. Conversely, consistently making on-time payments over a long period will steadily build a strong and positive payment history. This positive history is a cornerstone of a high credit score. It signals to lenders that you are a reliable and responsible borrower. Therefore, prioritizing on-time payments above all else is paramount. It's the most direct and effective way to positively influence this major category. Even a small forgotten payment can have disproportionate effects, especially if it's a recent occurrence. So, setting up automatic payments or reminders is a wise strategy to ensure this critical component of your credit score remains strong. The next category, credit utilization, also holds significant weight. It measures how much of your available credit is currently being used. This isn't about how much debt you have in total, but rather the proportion of your credit limits that you're utilizing. For example, if you have a $10,000 credit limit across all your cards, building upon the foundational understanding that credit scores are risk prediction systems is crucial to delve into the specific components that construct these intricate models. The architecture of most major credit scoring models revolves around 5 primary categories, each carrying a specific weight in the overall calculation. These categories are not arbitrary. They are meticulously chosen to reflect behaviors statistically linked to an individual's likelihood of repaying debt. First among these, and arguably the most impactful, is payment history. This category scrutinizes your past repayment behavior with an almost forensic level of detail. It looks at whether you consistently make on-time payments, which is the bedrock of a healthy score, But it doesn't stop there. The model also considers the occurrence and severity of any late payments. A 30-day late payment is less damaging than a 90-day delinquency, and a single late payment is less severe than a pattern of missed payments. Furthermore, the recency of any missed payments plays a significant role. Recent delinquencies have a far greater impact on your score than those from several years ago, as they are considered more indicative of current financial habits. Next, we have credit utilization, a factor often misunderstood despite its considerable weight. This isn't just about how much debt you have, it's about the percentage of your available credit that you are using. For instance, if you have a credit card with a $10,000 limit and a $9,000 balance, your utilization is 90%, which is considered very high. Higher utilization signals increase risk to lenders even if you consistently make timely payments. It suggests a potential over-reliance on credit or a lack of financial breathing room. Experts often recommend keeping utilization below 30% across all your accounts to maintain a good score. The third key category is length of credit history. This factor favors individuals with longer established credit profiles. It considers the age of your oldest account, the average age of all your accounts, and the overall stability of your credit relationships. A longer history provides more data points for lenders to assess your reliability, demonstrating a sustained ability to manage credit responsibly over time. Closing old accounts, even if they have zero balances, can sometimes negatively impact this factor as it shortens your average account age. Then there's credit mix, which assesses the variety of account types you manage. This category looks at whether you have a healthy blend of revolving credit, such as credit cards and lines of credit, and installment loans, like mortgages, auto loans, or student loans. Demonstrating experience in managing diverse debt structures indicates financial sophistication and a broader understanding of credit responsibilities. It suggests you can handle different types of financial commitments. Finally, we examine new credit activity. This category considers how often you apply for new credit and how recently you've opened new accounts. While opening a new account can be necessary, too many recent applications or new accounts in a short period can be viewed as a red flag. It might suggest financial distress or an increased risk of overextending yourself. Each hard inquiry for new credit can cause a slight temporary dip in your score, though the impact is usually minimal and short-lived. These 5 categories, with their varying weights, combine to form a comprehensive snapshot of an individual's creditworthiness. Understanding each component allows for a more strategic approach to managing one's financial health, moving beyond mere guesswork to informed action. It's a system designed to predict future behavior based on past patterns, not to judge personal income or wealth. By focusing on these 5 pillars, individuals can actively work towards improving their credit scores, unlocking better financial opportunities. Each element, from a single late payment to the age of your oldest account, contributes to the complex tapestry of your credit profile. Mastering these aspects is key to navigating the financial landscape effectively, ensuring that your credit score works for you, not against you. It's a continuous process of responsible financial stewardship where every decision, big or small, plays a part. These models are dynamic, constantly evaluating and reevaluating your financial journey.